Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending November the 18th, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is pause, pivot, or to the moon. I'm talking about interest rates and just where it's going to go, but I guess you could probably include in there inflation as well. Let's take a look at how we've done this past week and a little bit about some of the charts and see how things are shaping up across different asset classes. If we look at the week here, obviously everybody was in the red, but not by too much. I mean, the major indexes gave back some of the previous week's gains and closed, I would say, modestly lower, obviously led by the Russell and the NASDAQ being more growth oriented type indexes. We kind of started off the week with purported Russian missile strike in Polish territory, but then those rumors were dispelled and kind of moved over to Ukraine surface to air missiles that were trying to protect the area. So that kind of calmed things down and muted things for much of the week. So it was fairly calm. You can see the best performer for the week was Staples, which is a risk off type of sector value. Discretionary had the worst week. It was down 2.83%. And if we look at the PE ratios in the upper right hand corner, you can see still a little bit higher than I'd like to see, 17.75%. Some of them are calling it in the 16s. It depends on whether you're looking at Wall Street Journal or FactSet or some other Bloomberg, but they're all fairly, I think, higher than they should be. 10-year treasuries at 3.76%, certainly well below the 4% level that we saw a couple of weeks ago, but it's still higher by about 208 basis points over the dividend yield of the S&P, which is coming in at 1.68%. Earnings yield still a healthy 5.74, but the real yield, which you take into account inflation, you notice it's in the red, minus 1.66%. So that tells me the Fed still are not done hiking rates, okay? And you can see the VIX, it was up just a little bit this past week, up 2%. It closed out the week at 22.98. Prior week, it closed out at 22.52. So fairly benign in VIX. Although energy leading the markets as it had since we kicked off the first week of trading in January, it's up a little over 70%. Communication services bringing up the rear, 35.79%. This coming week, just as a reminder, we've got U.S. markets are going to be closed on Thursday, November 24th, in observation of our Thanksgiving holiday. And then Friday here in the U.S. markets are going to close at 1 p.m. New York time to kick off the Black Friday Christmas holiday shopping season. All right. So with really only about 6 weeks left before 2022 comes to a close, we're seeing all the major asset classes taking a hit. You know, you can see here year to date, up in the left-hand side, just about everybody's in the red. But we're also seeing not only that, but we're seeing bond funds are down about 17% for the year. Even 60-40 equity bond fund allocation ETFs are down around 15, a little over 15% for the year. So there was no place to hide. We do see energy and a few other commodity sectors up, but most investors in the U.S. are not heavily invested in commodity funds or trading commodities. Here in our trader user group, as we're bringing out the end of the year, we invest primarily in the SPX and a few other key sectors, depending on where the market is moving. And we're up a little over 18% for the year, so we're outperforming the markets by double, actually. So that's a little bit about what I'm seeing here in the U.S. markets. This past week, we also got industrial production falling in October. And we're also seeing prominent layoff announcements coming from some of the top tech firms. I know FedEx is doing it as well, Amazon, we're seeing others, Meta. So even all of these layoffs, though, we're still seeing fairly robust jobless claims from the previous week. They still remained basically contained. I think we had 222,000 workers filing for unemployment. You know, so it's been in a tight range of 214 to 226 really since late September. So we're not seeing a lot of that backing up. And inflation data is coming down just ever so slightly, which does suggest a peak. But if it stays up there as aggressive as it has, it's going to force the Feds. I mean, if we're looking at the 2-year, 10-year curve, we haven't seen it this low in decades, right? And we did get the Fed St. Louis president here in the U.S., James Bullard. He basically came out and said he could see rates reaching somewhere between 5 and 7%. So that kind of put a little bit turmoil in the markets midweek. Although the Fed fund futures right now are suggesting rates are going to peak around 5 to 5.25% by next March and kind of hold that through Q4 of next year. Okay. And one other thing coming up on everybody's docket before we wind down this year is we get the Fed's final meeting of the year coming on the 14th of December. Okay, and there's about an 80% probability that they're going to do a 50 basis point rate hike. All right, and just remember that's on the 14th, and on the 13th we get November CPI data. So it's going to give the markets a lot to chew on as we go into the end of the trading year for this year, but it's still a fairly ugly year for probably about 80% of most investors. And if you're in crypto, then God help you, especially FTX. A lot of you went belly up. And then, of course, if we look at across the world and we look across the oceans here to the European theater in the UK, economic forecasts there are suggesting the UK is already in a recession. They call for their economy to shrink in 2023 by 1.4%. That's the sharpest correction all across Europe for the UK. Okay. In addition, they also reported accelerated inflation in the UK. It's going to hit like a 41-year high of, or it has already hit it, hit a 41-year high of a little over 11%. Right, and that's a significant increase from 10.1% in September. So they're having their major issues. Utility bills are going to be through the roof all throughout Europe. So it's going to create some problems. There could be some food problems as well over there. And you can see, though, even given all of that, everybody was in the green across Europe. Euro stocks, FTSE, CAC 40, and DAX all in the green for the week. And the only one that's barely hanging on, but the only major index in the green across everyone is the FTSE, which is in London, which is having the worst economy. So it tells me that investors are saying the bottom is fairly well defined. It can't go much lower. So you're getting people trying to front run 2023 because the minute there's signs of progress and the market's reaching bottom, you're going to see a lot of money go in. That's why in our group, I've been telling our members to go long the euro, short the dollar if you're doing currencies, or just long the euro. And that's been a good trade for those of us that have been in our membership group that have been taking it. Okay. Meanwhile, over in the Asian markets, okay, the Nikkei was down a little bit, 1.29, 3% year to date. You can see China and Hang Seng up in the green, but everybody's in the red, right? In Japan, they got their CPI, their inflation. It rose to a 40-year high there. Now, a 40-year high for them is not like the UK or the US. Their 40-year high, believe it or not, is only 3.6% year over year. That's because the Bank of Japan has just been basically committed to its ultra loose monetary policy stance. They're pumping so much money into their economy. I don't even think it's a economy controlled by investors in Japan. It's mostly bank controlled, right? In addition, their economy unexpectedly contracted in Q3 1.2%. You'd never know it, but it's kind of a controlled economy. Like I said, with the Bank of Japan owning about 85% of all outstanding Japanese bonds and a big portion of their ETF market. So, but they're having trouble too because they also, like China, shut down hard on the COVID pandemic, and they're just now trying to open up, but they're having a hard time. So you throw on top of that global revaluations and earnings coming down, inflation still very high everywhere else. Japan's going to have a hard time getting back up above the waterline for a while because they export a lot. And then, of course, if we go further to the east or west and northwest, we got China and Hang Seng. Most investors in China kind of balancing the enthusiasm over a possible easing of their zero COVID restrictions against rising cases. So they're afraid the government's going to start shutting them down again. So that's really put a dent in the Chinese markets. Meanwhile, late last week, this past week, the People's Bank of China injected more liquidity into the banking system. So they're having their issues as well. As you can see, year to date, they're down almost 15%. Hang Seng is just having a hard time too, down over 23% for this year alone. So all in all, not that good for those markets, but that's kind of what I'm seeing right now. Let me just switch over to the screens here. Let's go into the E-mini S&P 500 futures. And what is going to take about 15 seconds to show up on your screen. And once it comes up, let's just kind of go through this major asset classes real quick, just to kind of see where things are shaping themselves out. If we look, you can see here. Well, let's just get the let's get this up here like this. Let's get that off, and let's get this up, and we're going to come to the E-minis. Where are we? Here we go, right here. So if we look at the daily chart of the E-mini S&P 500 futures, you can see we did a double test right down around where I said the bottom should be forming. Interim bottom, it was an Elliott Wave 5. You can see the 1, 2, 3, 4, 5 pattern. We hit really nice on my target area. I would expect a little bit of a drift lower, but the markets we're in the seasonal time when the markets really want to go higher, okay? The only thing that can stop it going through the end of the year, like I said, December 13th, we get the November CPI data, and then on the 14th, we get the Feds, right? Now, again, 80% probability they're going to hike the rates 50 basis points. And then from there, we'll see where everything is going to lay. If things come in fairly good, then I think we're going to run up over 4,100. We're going to test, obviously, the 200 EMA sitting just slightly under 4,100. You can see a fib node just slightly above that. So we got a lot of resistance overhead, but we need to get over this level first, okay? If I show you another view of it, but let me just give you a weekly view. Here's a weekly view of the SPX, the cash index. And you can see here where we came down and hit my target. I've got it shaded, but then the blue bar kind of marks the target area here. It was a giant ABC pattern here. You can see we've had a pullback of about 12.5% this year. It's a weekly chart, so this is the beginning of the year. We've had a bounce up of 12.5%. We've had a rally of 18.9%, and now we're at this rally of about 14%. So yes, we've had some big rallies this year, but again, every single one of them has been met either by a 200 EMA or this downsloping trend line. Okay, so that just goes to show we can move strong off the bottom, but it soon peters out, and we see a lot of short covering rallies moving up, and then big institutions are not stepping in to continue the upward momentum. They're probably doing some of the selling to lighten their load and change their position structure. Remember, we've been in a growth mode for over a decade, coming out of the 08, 09 financial crisis. Starting in 2010, when they started pumping money into the U.S. markets, tech stocks have been on fire. That's where most of the money's been. So we're getting some of that downsize, which is why NASDAQ's just been moving down pretty hard. Okay, and this is where we're sitting right now. Okay, now where are we going to go from here? We've got back inside the symmetrical triangle. I think the odds move us up a little bit, but like I showed you in the previous chart, we're going to run into major resistance up here around the a little over the 4,100 area, and then I think we're going to be stuck. The only thing that's going to climb us out of this and give us enough escape velocity to hit this prior pivot high here, sitting around 4,300, is a very positive inflation number and a supportive Fed. I don't think we're going to get, we may get maybe a slight downtick in inflation and a Fed that's not necessarily supportive, but still maintaining a tightening on the monetary policy. So that's just going to limit the upside from where we go. All right. So that's a little bit about what I'm seeing here. If we come down and we look at the VIX, and I've showed you guys before, in this VIX, you can see here we're kind of in the middle to lower end of the VIX. If I take it back for one solid year, let's go all the way back to January. Okay. And let's just take us on back here. Here we go, right like that. So right here's the beginning of the year. You can see every time we went up to this deeper red, we didn't stay up here very long. This was the longest we stayed up here, from about the end of February to the middle of March. So about 4 or 5 weeks, 4 weeks here, 3 weeks actually. And every time you don't see a lot of green bar prints over 30. Most of them are red bar prints where we came down and then a little bit of a jiggle back up and then back down again. Okay, one of the highest intraday moves was back on February the 24th, and then we actually closed on March 7th right around 36.47, but we gave it up very quickly. And then you can see down here below, when we get down into the lower 20s, or even the rare side this year of being in the high teens, we move back up again. So this move here should be expected to come back down just like every one of these others. If we kind of slide down and we have positive statement out of the Feds, and inflation is, it's come down just a little bit more. Um, we get the 50 basis point rate hike. The Feds say they're going to be, possibly pausing next year, but they're still going to continue with the hikes. Remember, there's a difference between a pivot and a pause. And I hear a lot of TV pundits are getting it confused. A pause is we're stopped rates. A pivot means they're going to start reducing rates. We're nowhere near a pivot, but we're getting closer to a pause. And that'll get the market volatility back down around this area here just in time to go into January, February, where we start to get Q4 earnings and forward guidance, which I think is going to be lower, and it's going to cause the markets, it's going to rock the markets back down again. And I think we're going to make new lows in the markets before we come out through the end of next year. So, and it just depends on how the lag effect and inflation hurts corporate earnings and whether the consumer continues to spend or not. We're going to get a heads up on it as we get into the retail buy-in season for Christmas. I think retail buyers are going to be a little bit more prone to save money from last Christmas, but we'll see how that plays itself out. And of course, if we look at treasuries, you can see the bond market. The bond market is trying to move up off this floor here. We had a little bit of a double test. We had the divergence, so we're sitting right on the 50 EMA here. I do believe bonds is probably going to move higher, which means longer term interest rates are going to move lower. And if you're going, well, why is that happening when the Feds are raising rates? Remember the bond market, which is, greater than 20, 30 years, and then the 10-year treasury, which is 10 years actually. Those tend to reflect longer term economic conditions. And when these treasury debt is moving up in price, that means interest rates are moving down, which basically means there's not a vote of confidence on the economy over the next year and a half. That's why we got that yield curve inversion with the 2-year or even the 30-month, the 3-month over the 10-year negative right now. Okay, so that's a little bit about what I'm seeing here. And of course, if we look at the interest rates, you're going to see the 10-year off the highs. All right. I do believe we're going to move down a little bit, and then we may catch ourselves, move back up. One final pivot on the 10-year, probably up in this area right up here around 4.5. You can see my next target range, and then we're going to give it all up. And then we're going to start coming back down again, right? So there's going to be some good trades in here. There were really great trades for us in the bond market using TLT as a proxy for folks that don't trade the futures market. And I think we're going to get some similar trades here in 2023. So we should continue our success as we've done over the past few years, trading these difficult markets. Actually, the markets from 2010 to 2020 were quite easy because you had so much money in the markets. All you had to do is close your eyes, buy any growth stock, and then you had an 80% chance of making money over a 10-year period. This past year was a lot more difficult. I think 2023 will continue into it as markets shift to a higher volatility environment and a higher interest rate environment as big money is shifting from a lot of growth into some more value plays and key sector classes that we're going to see. And this shift is still going on to this day. Okay. Currency market, you can see the US dollar finished up on Friday, but you can see that big downward shift here. That means the euro is up big time. The 200 EMA held it up. I think it's going to run up a little bit and then roll back over again. And the euro is where we wanted to trade, at least where I was sending our members to trade. And if we look at the euro futures, you can see here, look at that. I mean, this was the first break. And I was telling our members, this was really the first clear break of the 50 EMA for 2022. We broke it. We came back down. I said, wait for us to get back up above the 50 EMA and clear this initial pivot over the 50 EMA and then just play it long. And that's what's going on right now. It's been a great trade. And this goes, if you're trading currency pairs, then you could go long euro dollar or short dollar euro. But another easy way to trade it, if you don't want to do any of that stuff, is just trade FXE. FXE tracks the euro. And you can see this is following in the same path of the euro, right? So right over this area here is when I was saying just get long the euro. And then you can play that, and we have a way of playing it in our group that it really increases the probability of success. So that's a little bit about what I see in the euro. And then coming over here to metals, if we look at gold, I am still not convinced of gold just yet. Now, part of the reason of this, you got some short covering and you've got the dollar coming down pretty hard. And that tends to put a little bit of a bullish bent in gold, but I'm not convinced just yet. I think if we have a pretty good downturn in Q1 of next year, depending on where the dollar and interest rates go, um, we could see gold go lower, dollar go higher, because traditionally this 2022, when we have big downdrafts in the equity markets, the dollar gets stronger as a place of safety. And then when things start to go back up again, the dollar sells off and the euro gets a little bit stronger again. So we're going to see that type of relationship play out. Should we get what I'm expecting in Q1, early Q2, which is a pretty good little pullback, new lows and that kind of thing, and then we'll scare the children moment, and then we'll take off again. All right, that's a little bit about what I'm seeing. If we look at the energy market, well, oil has been all over the place, but mostly to the downside. You can see oil is kind of giving up the ghost here. Once we had that 5,200 cross, we bounced off the 2021 lows. We're still in the green for the year, but not very much in oil futures. And that is going to be a hard overhead burden to hit. But with the trades that we've been doing on oil, we should be making money. A lot of our members are making money in the way that we like to trade oil. So I see oil is going to not continue going down at that kind of velocity. It's going to probably catch itself. You can see the low price of 2022 is slightly below the close of 2021. So there's a lot of support right in this area here. Doesn't mean we can't take it out, but I think it's going to be kind of hovering around here as we get through the end of the year. Remember, on December the 5th, I think is when Europe and the U.S. put an oil cap on the price of Russian crude. That may last for a week or two until the folks figure out how to get around it, because they always do. The oil market's pretty smart in selling oil internationally. We'll see how they get around it. It'll be interesting to see. But that could put some more pressure on oil to the upside, but we'll see, right? We'll see how it plays itself out. And then, of course, if we look at nat gas, we've made some great money on nat gas. We traded nat gas up. We traded nat gas down. Both times we've been in, I've recommended short positions in nat gas over here and over here. Basically just picking up puts, right? Over here, this was a great trade for us. I said it's probably going to roll up here and then roll back over. My target is for it to come lower. It's very difficult, folks, for nat gas to stay this high, right? Now, it may go up harder up here because of the shortage of natural gas in Europe, and because we're shipping more nat gas over there. But if the winter months turn out to be more mild, which is what the forecast is, we're coming back down again. Natural conditions in the nat gas market generally see nat gas well below this level here, well below 3.5. So we're still tremendously elevated, right? But I think the risk of the bigger move is to the downside, not to the upside in nat gas, right? So that's a little bit about where we're sitting right now, everybody. Members, I will see you in our weekly market watch this Sunday evening. For those of you that are watching for free on this weekly roundup in our blog, I highly encourage you to come in. Next year is going to be, I think, a really great year for us. There's going to be several scare the children moments. We'll be coming out with a little marketing thing here. I normally don't do these things. Most of the people that come to us come through referral, but I'll be doing a little marketing thing this holiday season, getting folks in. So certainly welcome to come in, take advantage of it. Have a great weekend, everybody. Members, I'll see you tomorrow evening for our weekly market watch at 8 p.m. New York City time. Take care, folks. Ciao.